FBAR is triggered when the aggregate maximum value of your foreign financial accounts hits over $10,000 at any time during the year. At any time is the trap. You can spike above $10,000 for one day, then end the year at zero, and you still file. On the EA exam, they love that the year-end balance doesn't matter for FBAR, only the maximum during the year. Joint accounts are another exam favorite. If both spouses must file separate FBARs, each spouse reports the entire maximum value of the joint account, not just their half. That feels unfair, but that's the rule. Also remember, a minor can have an FBAR filing requirement too if they're an owner of the foreign account. Ownership drives reporting, not who deposited the money or who uses it. There's a narrow shortcut for married couples. One spouse can file for both, but only if every reportable account of the non-filing spouse is jointly owned with the filing spouse. Then the non-filing spouse signs Form 114A to authorize electronic filing. You don't submit 114A with the FBAR, but you keep it in records. If either spouse has even one separate foreign account, this shortcut is off the table. Now, what counts as a foreign financial account? For FBAR, it's about location. The account is outside the United States. That includes foreign bank and securities accounts. But if you buy foreign securities through a U.S. brokerage, that's not a foreign account for FBAR purposes because the account is maintained in the U.S. Also, certain accounts aren't treated as foreign financial accounts, like those owned by a governmental entity, an international financial institution, or maintained on a U.S. military banking facility. Safe deposit boxes are where people get twisted up. A foreign safe deposit box, by itself, is not a financial account, so the box isn't reported as an account. But here's the edge case. Gold, bullion, or foreign currency held inside a foreign financial institution can create FBAR reporting. Compare that to coins and cash in a wall safe at home. No foreign financial account exists, so no FBAR from that fact alone. On the exam, watch the words "at a financial institution" versus "held directly." Last, don't mix up FBAR with Form 8938. FBAR is Bank Secrecy Act reporting filed electronically with FinCEN, separate from the tax return. Form 8938 is FATCA reporting filed with the Form 1040, and it can cover more than just bank accounts, like certain foreign securities and interests in foreign entities. The thresholds are also totally different. EA exam tip. If the question says not just bank accounts, your brain should immediately think Form 8938. According to the IRS, which factor does not weigh in favor of the IRS approving equitable relief? The choices include abuse by the spouse or former spouse, poor mental or physical health when the return was signed or relief was requested, the taxpayer still living with the spouse, or none of the above. Think about which one is actually an unfavorable factor. The correct answer is the taxpayer requesting relief still living with his or her spouse. Living with the spouse is generally an unfavorable factor, so it does not weigh in favor of equitable relief. A tempting wrong choice is poor health because it sounds negative, but for equitable relief, it can support the taxpayer and weigh in favor of approval. Which form requires U.S. persons to report various types of foreign assets, not just bank accounts? The options include Form 8938, Schedule B, Form 8300, and the FBAR. Think about which one is designed for broader foreign asset reporting, beyond just accounts. The correct answer is Form 8938. It's the statement of specified foreign financial assets, and it can include foreign accounts plus other foreign assets like certain securities or interests in foreign entities. The tempting wrong answer is FBAR because it's the famous foreign reporting form, but FBAR is focused on foreign financial accounts, not the broader asset category.